Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Don Gray from GIVX Information Technology. GIVX trades on the TSX under the symbol GIVX and on the OTC under GIVXF. The company is currently trading at 89 cents with roughly 118 million shares outstanding, or about $105 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Mr. Gray, CEO of GIVX, happy to have you here today. This is a company that Trevor and I have taken a couple looks at in the past, and we had a chance to speak about 4 or 5 months ago. Relatively new company, you just got listed this past year, so very happy to sort of introduce the company to our subscriber base. And on that note, Don, I'm going to hand it over to you and allow you to start your presentation.
Right, great. Thanks, Paul. Well, GIVX is a company that's been in business actually for over 20 years. It was started by myself and my wife over 20 years ago. Started as a small gift certificate company that we sold gift certificates for merchants in the Toronto area online. And those certificates were then redeemed at the store or at a restaurant using a touch-tone phone. That's how old the technology was back then. But we've since grown to a much larger company. We have over 300 employees. We have clients in over 100 countries. We have, we do a significant amount of business. We have 10 data centers with 10 in 10 different countries. So we actually have operations in 10 countries. We have over now almost 113,000 clients, client locations. The business is fundamentally works around 3 areas, which I've got here. Engagement, which is our gift and loyalty card programs. Point of sale, which is everything to do with the POS systems at a restaurant location, restaurant and or retail, so not just restaurants. And because you need a good point of sale system in order to be able to run a loyalty program or a gift card program effectively. And then recently we've just added payments. So to give you kind of a snapshot of how that would work, Second Cup, which is a client of ours in Canada, started many years ago as a $50 a month gift card client, and they're now over a $300 a month full platform client. And if you go into a Second Cup, you can use an app that you've got on your telephone that would allow you to order your coffee in advance or order it online. That app is something that we developed. You can earn loyalty points or pay your bill with the phone. That's also an app that we developed. When you go to do a touch at the POS and it orders and creates a bill or records a transaction, the POS, that's also our technology. All of this is kept on a database, which is our cloud-based system, which we developed many years ago. So that we can provide the clients with great analytics and good information. And so our strength really as a company is our ability to have all of our functionality working on the same platform. So that's just a snapshot of the company. And maybe if you would like, I can just kind of go through some highlights from our last our first financial year as a public company.
Please do, yeah.
So we were private right up until basically October of last year, and we went public, and we moved our auditors to KPMG. We had a smaller firm that was doing our audit before that. We audited every year. We paid dividends for almost 10 years straight. We started the company with just over $3 million in equity over 20 years ago, and never raised any future funds. So we've been very cash conservative and very capital careful. But now, as you can see, I think I alluded to over 300 employees, 113,000 client locations. Most important, we have less than a 1% churn. We don't lose clients once we get them. 10 global offices in over 100 countries, and no one client represents more than 2% of our customer base, so of our revenue. So we are not dependent on any one client. If for somebody leaves, we're not. It's not a problem. it's a problem. We don't like losing clients, but it's not going to have a huge impact on the business. Last year, our revenue grew by 7% to $55 million, even with the pandemic. The last quarter was particularly rough because there was more lockdowns that came out in the last quarter, but we still managed to have a good year. Our gross transaction volume, which is all the value of the transactions going through our system, grew by 19% to over $6.5 billion as processed through our systems with our clients. And our POS transaction volume, which is kind of the newest, a newer part of the business, accounted for almost $1 billion of that, well, $800 million. So that part of our business is growing rapidly. Our adjusted EBITDA for the year was 8.3 million, which is slightly down from the previous year. But in 2020, we were able to take advantage of the CEWS, so we had a pretty good EBITDA as a result of getting some benefit from that. This year we didn't have that same benefit, so in real terms, our EBITDA went up as a percentage of our revenue. And our customer locations, which are $100,000 at the end of the year, but now they're up over 113,000, which is an increase of 5,000, almost 5%. So, during the fiscal year, we have basically, you can see this is our historical information as the company is growing. It grows every year. It's been growing every year since we started. Our basic business, which is a gift and loyalty card business, which started many years ago, is the core of our business. It really represents most of our revenue up until probably the last couple of years, where the POS business is starting to get more and more a bigger part of the business, and it's also providing virtually similar gross profits as the gift card business. Because once you install, because it's a cloud-based POS system, once you've installed the system and put the hardware in, which are basically tablets and some printers, everything else runs on the same platform as our gift card program. So the margins on the monthly service fees are very similar to, which is about 80%, which is very for our POS as well as our gift cards and our loyalty programs. Payments, when we get as we add more payments, the revenue model there is we sell payment services for approximately 3%, and we may pay 1.5%, 2% for that. So we're making about a 50% margin on payments when that starts to move more effectively through our system. Right now, it's a small part of our business because we just really launched it in the last part of the last quarter of the year. I can keep going through this, or I can stop and answer any questions, or should I just keep running through this deck and then answer questions as later?
I think, run through the deck, and we can always ask questions once you're done.
Okay. So basically, here's our 3 months performance for the last quarter. As you can see, our transaction volume went up because we have a lot of clients on fixed monthly revenues. That's how we started, how we transitioned the business many years ago. We started moving away from a transaction model, and we moved to a flat monthly fee model. So our real focus is to get more and more locations. So we increased the volume, we increased the number of locations, and then we increased the services that we provide to each location. Again, our EBITDA went down a little bit because the last quarter of last year was bumpy for a lot of our clients. So if the client doesn't do a transaction during that particular quarter, we wouldn't have recorded it as revenue. And so, we saw some customers actually having to close down in the last quarter of last year. They're all back now. So we're starting to see this recover nicely in the first quarter. Revenue is down slightly for the same basic reason. But overall, for the year, we're up over 7%. So again, it's the same basic information. I don't want to kind of keep going, but 12 months compared to last 12 months, up over 7%. We had a growth in EBITDA was again, it was 8.3 compared to 9, but then we had a much better boost with CEWS in 2020, almost $3 million. So the difference is quite significant in real EBITDA. And then our gross transaction volume continued to grow, as did our customer locations. So some of our fourth quarter highlights, we listed our company on the Toronto Stock Exchange. We went right to the TSX. We didn't go to the Venture Exchange. And at the same time, we raised approximately $22 million. We now are sitting on, at that time, we're close to over $37 million in actual cash and cash equivalents. We've spent some of that money in the first quarter with a couple of acquisitions, which I'll talk about shortly. We launched our GIVX payment processing solution, which we've been working on for years, for about a year, with Adyen, which is a global payment processor. So we're a PayFac. Adyen is our partner, and they look after all our KYC in the background, but we can now sign clients ourselves and board our own merchants and act as a payment facilitator. GiveUp Barbarito, to give you an idea, this is one of our clients. They started off with 70 locations. They now have 170 locations. So this is an example of our clients growing, and we grow with the client. They started off with GiveX POS, but they ended up becoming, they added our loyalty programs, and they added our wallet and our online ordering. For Upticks, which is our stored value ticketing program, we had the Buffalo Bills, Colorado Avalanche, the Blue Jackets all signed up. Then we just, excuse me, I'm talking at a speed talk here. We implemented our end-to-end technology solution for a third of Foodtastic's 650 restaurants. Now they've grown over to 800 restaurants, and we're going to be rolling out our POS and all of our solutions to all 800 of these restaurants. Importantly, in Brazil, we signed up a company. Excuse me a second. I'm just going to have a little sip of water. We made a deal with iFood, which was one of the largest. It's a food delivery company that's in Brazil with over 100,000 riders running around on scooters. I don't know if you guys are familiar, if you've ever seen that on TV with people driving motorcycles between the cars, but that's what they do. They deliver food, but they also have an application, the iFood app, which has other functionality where you can buy pharmacy. It almost works like a little bank wallet. And GiveX is providing the stored value services on that wallet, and it's proving to be a very lucrative business for us in Brazil, and they're just expanding it now into Colombia, and they expect to drive it more into more South American countries, and that becomes a very very profitable business for GiveX. We began. And I think actually just at the end of the last quarter, Milestones Restaurants, which is a well-established restaurant chain, at least in Eastern Canada, 40 locations, they flipped their POS system to us. We did the whole thing in less than 2 months, and we have added the kitchen display systems and all the functionality that goes along with a great POS system. They're using our online ordering, and they're also using our web application for their mobile app. So basically, how does GiveX grow? Like, why is it a good investment, or why is somebody look at it making an investment in the company? Well, we are a steady growth company. We have been for many years. We grow at an average rate of 5 to 8% a year, just with our existing base growing. The clients grow, for example, Marriott, which is one of our clients globally, started off with 2,000 hotels. They now have 5,000 hotels. So that client grows, we grow. We also are doing outreach for our gift and loyalty card programs, and we're signing new merchants all the time. And with RFPs, we're winning RFPs. But that traditionally has just been like 5 to 10% a year. We've been a consistent growth every year on a nice even keel. But we don't want to grow at 5 to 10% a year. So we're starting to look at doing a more aggressive acquisition program. And to that end, we made 2 acquisitions in the first quarter of this year. We bought a company called Givex for that does about $5 million a year Canadian in revenue, and their focus is on installations of POS systems, and they have some of the largest brands in Canada where they do their like KFC, Pizza, Harry Rosen. These are some of their clients that they actually do technical services for. We bought that company for 2 reasons. One, to get access to the client base so that we can actually start selling our gift and loyalty card programs, not necessarily our POS because those are well established, but we wanted to be able to sell them our gift and loyalty card programs, which we've been successful in. We know we can do because Pizza, for example, is already a client of GiveX. So we know that these customers are a potential opportunity for us. But the real reason was to get the expertise that John Beaton and the team over at Givex is bringing to the company to help us improve the way we do large rollouts and acquisition. When we do sign large clients like Foodtastic with 700 locations, we want to make sure that we can do those effectively. And he's already started at great value simply in the buying side, etc. So that's proving to be and this company, like both the acquisitions, has no debt, has been profitable for years, so we're not buying a problem that we have to fix. Loyalty Lane is the other one. It's a company in the United States. They've been around for 15 years. They're a company that specializes in loyalty for grocery. So the grocery stores, they have couponing, very specialized couponing, where you, for Procter & Gamble may offer a coupon. You as a consumer want to use that coupon. Basically, that has to get together at the point of sale system to make sure that the POS, deducts the value of the coupon, and then the Procter & Gamble ends up paying the merchant for the discount. So these are programs that these guys have been working on for years, and they're very effective at the job and what they're doing there. Again, it came with no debt. Those two companies will add a comfortable $10 million. It's just what they have, just bringing in from last year. They're going to grow for sure, so it'll definitely be more than that. So with GIVX's normal growth this year, and with these two acquisitions and others that I'm certainly looking at, we're looking at pretty comfortably seeing a $68 to $70 million growth year for 2022. And that's just off the data that's already available. So I'm not really doing anything other than saying what's already in the news. We have the other part of our business, we land and expand, which I have explained a little bit before. All of our existing customers, now we have 113,000 locations. Our objective, obviously we're not going to do it with all of them, but hopefully 10 to 15% of those clients over the next couple of years, we will sell them all of our services. So they become much more high value clients. So instead of being a $50 client, as I said, they become a $300 a month client. So we have been successful doing that, and we believe that we'll be more and more successful with this as we go, because our POS systems today are much more robust and work much more effectively than they did a couple of years ago, with many years of experience now behind them, and we're now being known as a POS company. Before we were just known as a gift card company or a loyalty company. Now we're being seen as a very effective POS provider. Barb, I talked about Barbarito already to give you an idea. And organic growth, of course, will continue to grow. We're out there bidding on RFPs. We won two very large RFPs at the beginning of this year, which will probably be worth significant. I really can't talk about them too much, but they're large RFPs worth many hundreds of thousands of dollars a year to the company. So we're satisfied that that we will continue to see our organic growth continue to move at 5 to 8% a year. We had these accelerate that with M&A and more land and expand. We should be able to see some faster growth for the years coming, but yet always at a profit. My objective had always been from the day I started was to make sure that we always were growing the business at a rate that made sense, and that we would always have a positive EBITDA. This year we came out with a 15% EBITDA. And I expect to continue to do that as we grow the company. We'll continue to be at 12% to 15 up to 18% EBITDA as the company grows. And I think we're quite confident that we'll continue to maintain those EBITDA margins, because the type of companies that I'll acquire will fit that model as I acquire more companies in the year 18 months ahead. The size of the GIVX, the market for engagement, point of sale, and payment, which is our three core areas, is huge. There is no one competitor of ours or anybody out there in the market that even comes close to dominating this market. You look at the largest companies out there like NCR or FleetCor, or Value Systems, Fiserv, TSX. In all their market segments, none of them come close to dominating their markets. So there's plenty of room for companies like GIVX to grow from a $70 or $50 or $60 million company to a $300 to $400 million company without really dominating the market or even trying to dominate the market. And we can do it profitably. We don't have to go out there and try and buy huge market share, which some of our competitors have tried to do, which hasn't really been proven overly successful. But that's the attempt. And we didn't want to buy into that market or into that concept to spend all of the money that we raised or all the money we're doing to go out there and just try buy market share. We think we can earn market share. We've done a good job at it, and we're going to continue to do it what I consider to be more focused, conservative way. basically, I've already alluded to what we do and how we do it. We have our three main platforms with engagement, payments, and point of sale. But also with that, along with that, we have integrations. Because GIVX started as a POS company, as a gift card company over 20 years ago, we had to learn how to do integrations with virtually all the POS companies that are in our core markets. We had to integrate with the payment platforms because often our gift card programs, even some of the loyalty programs, were actually on payment terminals. So we have well over 1,000 integrations and or APIs that we can integrate with virtually anybody. So the concept is we want our clients to be on our platform. We want them to only use our platform if they can, because it gives them one throat to choke. But at the other side of the coin, there are customers that just say, sorry, Don, we just can't use your POS system, but we'd love to use your gift and loyalty card program. No problem. Or they want to use our POS system, but they already have an existing loyalty program. No problem. So the concept is we want to provide our clients with flexibility so that we can get in the door, start working with them, and then sell them more services over time if we can. So we can start with one and add more later. And then, of course, we want to be able to provide clients with great analytics. It's no point in having all this great technology if you cannot use it, if it doesn't come in a package that makes it easy to understand. We looked at analytics programs for a couple of years, 2 or 3 years ago. And the more we looked at them, the more complex they got. Most of our clients would not have the technical team in place to be able to look after them. They wouldn't be able to continue to load the data in they needed from their third-party systems. And so we decided to build our own that would run on the same platform as all of our other services. So now our analytics is an integral part of what we do. So you have your gift programs, your loyalty programs, your POS systems, all the stuff to do with KDS or speed of service, your payment platform as it's now being added in there. So now you get all this data, it's rich data that we can then help our clients know who their clients are, where they are, what they're buying, what the trends are in certain areas, age, sex, everything, that if people are opting in, you can gather this data, which makes it a much more effective way of marketing to your client base. So that's what our basic business is to kind of put all this together on one platform and to make sure that, and then sell that to our clients one step at a time, or the whole enchilada, if we can. Basically, why do people choose us over our competitors? Well, we have, we've invested because we have one of our largest clients in the U.S. is a major U.S. bank where we do their back-end gift card portfolio. It's a big client of ours, very significant customer, but it's a U.S. bank and they are very, very security focused. So as a result, we put together our own security protocols. We are PCI level 1 compliant, which means we can handle payments online or on a POS device. We go through a PCI audit every year. We do SOC 1, SOC 2 audits. We have all these third-party questionnaires and third-party compliance audits that we do. So we basically can go after any large client because we pass all of these security protocols, which is very important. The companies that we've acquired, for example, none of them would have this security protocols in place. They wouldn't have the ability to go after major clients because they don't have those, their data centers or their systems don't have the same level of security that we have on our systems. We have an extensive API library, as I alluded to before. We're very competitive priced because GIVX works on open source platforms. We're Unix based. We don't work on Microsoft Azure or on AWS. So as our business grows, the cost of our business doesn't grow at the same, basically the same speed as our revenue. We can keep our costs down because really we can add data centers for the cost of, quite nominal for the cost of some servers and a couple $1,000s a month in rack space. So that's why we've been able to set up data centers in different parts of the world, which makes us quite unique in the business. Even our largest competitors tend to have all of their data centers in the United States, and all of the clients around the world have to, connect into the US to do their work. This is making some people in European markets and Asian markets uncomfortable. They don't want their data moving outside of their own jurisdictions. So we have data centers in, in Asia. We have data centers in Australia. We have them in the United States. We have them in Canada and Europe and the UK. So, we are in the position where we can say, well, the data stays in the local jurisdiction or local area. And we also operate in these different languages and different currencies. So we operate in many languages and currencies, and we are unique in that respect. Even our big competitors are, a lot of them can't say that they operate in many languages, many currencies, in different countries with local data. So there's a lot of localization. And as a result of that, we're also very flexible. As I talked about before, we're upgrading our services constantly. We invest millions of dollars a year in upgrading our software on a regular basis. Every 4 times a year, we're doing upgrades to our system. And the nice thing about a cloud-based system is we're only running one version. We don't have versioning systems where you have to worry about different versions of the software. We have extensive reporting and a single source, which I talked about before. So really, when it gets down to it, clients choose us because we have excellent service. We have continuous improvement. We continue to look after ourselves. We have strong references. All of our clients are good references for GIVX, and that equals small churn, upsell opportunities, and a constant flow of new opportunities. Give you an idea of some of our clients. We've got them kind of segmented here by restaurants: Wendy's, Swiss Chalet, A&W, Focus Brands. These are, Canadian. Focus Brands is US. iFood is in Brazil. We've got a lot. This is just some that I think people would recognize. We've got some retail stores: Tommy Bahamas, Fannie Mae, which is a confectionery group out of the US, 7-Eleven in Australia, and parts of the US. And we have Major League Baseball, the NBA, the NHL are all clients of ours, not necessarily all teams, but most of the teams in the MLB are, where we provide a value-added ticketing, so you can add value to a ticket. When you go to a game, instead of using cash, you can use the ticket as a way to purchase items at the ball game. You can load it before you go, and it's now moving to an app, so you can do in-seat ordering, so that sort of thing. And that's one of the reasons we're able to sell Major League Sports, Maple Leaf Sports and Entertainment, which you see on the far right-hand side. They were actually very interested in some of this stuff, starting off with a gift card program, but we expect that they'll be moving to upticks over the next year. And in the hotels, we do one of our retailers, by the way, which is not on this list because we are restricted on what we can put out on public documents, but we can talk about them. And Nike we've done Nike globally. We do all the Nike stores around the world for the gift card program. We've done that for over 15 years. In the hotel side, we've got Marriott Hotels, which is one of our clients, been with us at the same time, 15 years. Fairmont, Best Western, Carlson, Residor, and others. MGM Resorts in Macau, we do some really interesting things for them. And then Canada, we do almost all of the liquor stores in Canada, pretty well, I think all of them, except I'm not sure, there's one that we don't do, and I can't remember which one, but we do all the liquor control boards in the country where we do the gift card programs, LCBO, we do OLG in Ontario as well. So just to give you an idea, we have a wide range of clients, very large ones, with Wendy's with 11,000 locations, and small ones with 1 location. So we run the gamut. Okay, that's kind of it. That's our board. I can talk about that, but then so this is that was kind of my overall pitch. I think I got that done in 20 minutes.
You did a great job. Great job. Great job. Thanks, Don. Let's talk about sort of general directions. When it comes to new products, you mentioned you're spending a lot of money in R&D, but give us a sense of like where do you take that R&D? Where do you want to improve your technology, or what areas you want to go after?
Well, a lot of our R&D is client driven. Customers are asking for new functionality. They see it somewhere, they want it. So, like for example, 2 years ago, we didn't do kitchen display systems. Well, we added kitchen display systems because that helps improve the speed of service towards the kitchen. You can measure how long it takes from the time somebody sits to the time it goes to the kitchen, and how long it takes for various courses and everything. So, that was driven by clients asking us to do it. So we built it, and now we sell it regularly to our clients. We spent a lot of time and energy on payment on GIVX Pay because we wanted to get into the payments space because a lot of our competitors are there. So we focused on that. We'll continue to enhance that where we can do this now in Canada. We're about to launch it so we can do payment in all of our markets around the world. So there's significant work that has to be done on that, but it's pretty well ready to go. And I've got a team of I call them my skunk works team, University of Waterloo, and we're working on things like how can we do things like virtual reality, where can we get into the metaverse in some way for gift cards? Can we get into the metaverse for loyalty programs? We're tinker with ideas like that. I'm not saying we're going to do any of them, but we can tinker, and we do tinker with concepts. Because you never know where they're going to go. We're also looking at crypto as a way, what can we do with gift cards, and because there's a huge opportunity to potentially do crypto gift cards, or be able to take your gift cards and put them in a crypto wallet. Lots of little ideas there, that are, the concepts are there, but we can flesh those out. So that, we'll continue to work in the same general area that we're in. We're not going to go too far out of our field. Like, we're not going to start figuring out how to, we're going to stay in hospitality, retail, grocery now, because we're in grocery. We are looking at things like, basically hands-free grocery shopping. How do you do that? Or, staff lounges where, you can do hands-free, where you can order off a kiosk, etc. So our R&D will continue to be, to strengthen the product that we already have, and our acquisitions will be the same thing, to actually find more clients that are far more locations that we can sell our services into. So we'll be buying companies that will help us make that happen.
And you touched on it earlier, but give us a sense, is it a monthly fee that somebody pays? You mentioned it's not transactionally based, it's a set fee, but is it a monthly basis, or do they pay over a year? How long the contracts? What can you tell us there?
The clients, it varies. We have the majority of our clients, probably more than 80%, pay us on a monthly basis. So there's a monthly fee based on the number of locations they've got. Some clients say they're small, maybe they only do maybe $15,000 or $20,000 worth of business with us in a year. We would probably do a flat rate with them, where we just sell them the whole thing up front. They buy it and they use as much as they can. It may take them 6 months, may take them a year, maybe take them 18 months, but they buy it all up front. We don't, if they buy it and don't use it, that's their problem. They buy it and they use it, then that's great, then they'll buy more from us. So we call that a client a reoccurring revenue, not recurring revenue. Recurring revenue is the stuff that comes out every month. And our reoccurring revenue, we have some of that as well, because the client's definitely going to come back. And then we have some clients where they are, they are on a traditional transaction model, because that's more around payments, and that pretty well you have to do it around payments, transaction model payments. And so that part of the business, we'll see more transactions as a result of payments over time.
I think I heard you say you got something like 113,000 sites that you sort of work with. Give me a sense of what's your cost of acquisition per either site or client, or however you measure it. What can you tell us?
If we're buying a company, or if we're selling a site?
Well, every time you go and get a customer, what does it typically cost you to get that customer, do you think?
Well, I guess we would have to look at our gross margin on our business on a regular basis is 80%. So let's say our cost of acquisition is probably half of the 20% cost of sales. In other words, the cost of going out, the sales team, people going out there, our customer service managers, client relationship management team, that would be half of that 20%. The other half of that 20% would be real direct costs associated with, say, plastic cards, or with maybe data center rentals, things like that. So I would say it's like probably 10%. Probably 8 to 10% of our revenue.
Yeah. Now you mentioned RFP, so that's clearly one way you get clients. But is this sort of door knocking type of sales? How do you get your clients?
Definitely. We have over 30,000 names in our client relationship, or in our lead tracking tool. We have a team, almost 15 salespeople, and we have about 5 kind of lead generators that are out there pounding the phones all the time in all of our markets. So it's not like we just do this in Canada or the United States. Everywhere we're pounding on, we're introducing ourselves to as many people as we can, and then we follow them up through our tool, so that we are we're definitely doing outreach all the time. that's how we're able to attract RFPs. RFPs are something we pretty well have to do now on any client that's over $300,000 a year. You pretty well have to do an RFP. That's become very impersonal. A lot of these RFPs now are all automated. It's kind of just put your data in, and then hopefully they ask you good questions and make some good decisions.
Gotcha. Now, you mentioned your churn is less than 1%. So clearly you're keeping your clients, but how long, is there any contractual obligation with these clients?
All of our clients initially sign up for a minimum, usually it's 3 years, some 5 years, but every contract has an automatic annual renewal. So everybody renews automatically every year. So we don't go and talk to the clients again, okay, we want you to re-sign. They automatically re-sign. Right. And so customers that have been with us for many years have got kind of the original contract, and it's just been renewing and renewing and renewing. And some customers will want to actually go in and then renegotiate the contract or discuss it, and so then we'd sign a new contract with new features and so on. But yeah, so every client is under contract, and we are for sure. And every contract to start is at least 3 years, maybe 5, and then it's an automatic renewal after that.
Once you have a client, how difficult would it be for them if they decided to switch to a competitor or just decide to go in a different direction? I got to imagine it's pretty disruptive to change at this point.
Yeah, it's not. It's not easy. Of course, it's done because that's how we pick up clients from our competitors. Because so for gift cards, it's not that hard because there's a database. You want to pick up the database of cards that what the cards are outstanding, and transfer them over. Where the issue becomes is on the point of sale, because usually it's the point of sale integration where a lot of the issues would be, because of the customer. If we don't have, or they don't have an integration with us for POS, and it's pretty hard for us to do it. But at the same time, if our competitors are trying to take some of our clients, then they better have a pretty robust set of integrations, because we've integrated with virtually everybody. So yeah, it's loyalty is a little more difficult because there's a lot more data involved in loyalty, and you want the historical information. You want to be going back many years, so it gets richer. So it's definitely more difficult. Payments, I don't think is that going to be that difficult at all to change. So, obviously we're going to be doing that, but yeah. So we don't lose the clients, but it's not that difficult to change a gift card client, which is good because we don't lose them, but we can pick them up.
You can't pick them up from others. Yeah. What kind of insider position is there in the company? How much do founders and insiders own the overall company?
Myself and my wife control close to 40 million of the 118 million shares that are out there. We have another 2 shareholders at about 25 million between them. They're not really, I guess you'd call them, they're not insiders, they're just larger shareholders. They were some of my initial shareholders, but they're not, other than by virtue of their size, but they're not insiders, not privy to inside data. And then the rest of it's free trading are out there. The large blocks are, they're under certain restrictions at the moment. And we should see them. We'll probably see some of that come out in the next couple of months, half of it, and then half of it again another, I think 4 months after that.
Yeah. Now, you raised some money when you got listed. I think you said you had $37 million in cash prior to the 2 acquisitions you did. So by my math, you got about $26 million in the bank right now, give or take.
No, it's over 32. It's
over 32. Okay, then bad math in my part here.
32 at the moment.
Okay, good. Do you foresee
cash and cash equivalents type?
Okay, sure. Do you see? I mean, is your M&A pipeline strong enough where you might have to go back to the markets, or do you think you can continue to sort of grow your business with what you have?
The way I do my deals, first of all, I'm not trying to buy companies that are doing $30 million in revenue. I'm looking for clients that are doing 5 to 7. That's kind of the range. That's the hot spot. That they're run by an entrepreneur, having for at least 5 years. they probably have hit a wall now on being able to kind of take the company to the next level. They don't have the capital. They have good, maybe they have some good tech, or they've got some good market penetration. Maybe it's a Windows-based POS system, and they just don't want to invest any more money in getting it PCI compliant, things like that. So we, by acquiring a company like that, like we did with Loyalty Lane, for example, a lot of great tech, but they were getting to the point where they need more, but they couldn't afford to invest more because they would need to raise more money to do it. So for them, it made more sense to sell the company. And when we buy the companies, we do a combination of cash, some vendor take back, a little bit of bank debt, and then some GIVX equity. So we do a combination of these things, so I can leverage 22 million or 30 million. I mean, really, I targeted the $22 million that we raised really to focus on acquisitions, because GIVX is always cash flow positive. So we've never really needed money. We raised money back when, years ago, and we never had to raise any money after that. And we continued to build our bank account. So yeah, we don't really. So the business generates cash nicely, and then we raise the money for the acquisitions. But if between the shares and the cash and the vendor take back and some bank debt, we've got a kind of a little toolbox there that I can go after these deals. And I won't pay anywhere near what any of these other guys are paying. Like I only paid 1.5 times for Loyalty Lane, so that 1.5 times their revenue. Historical revenue, not even forward-looking revenue. And for KLX, I only paid half of their revenue because they don't have any real technology. It was just more of a services business. So, I'll be very conservative on what we're buying. Now, of course, if some massive, great, huge, interesting opportunity comes along, I have my bankers all primed up. They're more than willing to kind of work with us. So, but I'm not. I don't expect that we will be doing anything like that where we would. Go into huge debt or anything like that to try and continue to grow the company.
Very nice.
Right now, I'm also, the stock at the price it's at, I think it's pretty cheap. So we're being careful too about giving away our stock on any acquisitions. And if I do, I'll be doing it at a premium anyway. So we're not going to be doing it at a discount.
Gotcha. What are the challenges you're facing right now? Where are the speed bumps?
My biggest challenge and always been the same challenge is people, making sure that we can not only recruit but keep good people. Now we're very lucky. I've got people working for me that have been working with us for over 15 years. We've got a very strong core group that owns stock in the company. They're shareholders. They have a vested interest in staying with the business, but more importantly, they've been with us for 10 years, 12 years, 15 years. So they're not going anywhere. They really like the company. They know, there's great opportunities. But as we grow the business, we need new people. As we're hiring new people and getting them into the company, it's a challenge because we're competing against, in Toronto, we're competing against Amazon, we're competing against Google, we're competing against Microsoft. It's like in the Toronto area. So as a result, we've now got more than half of our client services team working out of Mexico, because we can recruit in Mexico at a third of the cost is in Toronto, and we can helps us keep our costs down. And they're great people, very smart, multiple language speakers, and so we're probably going to continue to grow that out. So, but that's our biggest challenge. Our second biggest challenge is to make sure that GIVX, we get our name out there, our message, know who we are. Not only from selling our services, because people know us as a gift card company, but they just beginning to get to know us as a platform company. And that's important. So getting out there, making talking to guys like yourselves and others to try and let people know who we are, that it's a good solid company, been around for years, and is going to be here for many more. And we pay attention to our management and how we run the company, so that we look after our investors. The original investors in GIVX all did very well when we took the company public. Very few of them want to sell. They think we can continue to grow the business. They will sell, obviously, if at the right price. But they're, a lot of them are sticking with it.
Perfect. Fair enough. Let's take a couple questions from the listeners here. I've got one here. In regards to your marketing, sales and marketing expense, it says, was less than 2% of revenues. Is there an opportunity to increase to drive organic growth?
2% of revenues. I said 10%.
Yeah.
Yeah.
Well, it said 2%, but let's assume, well, pick any number. Is there an opportunity to grow that? Would you be willing to spend more money on sales and marketing?
Well, I think we're always looking to spend. Yeah, we'll spend more money on sales and marketing because as the company grows, we'll have more revenue, more cash flow to spend on sales and marketing. We certainly by these acquisitions are also going to bring in more sales and marketing teams. But I'll still want to keep that within reason so that we're not blowing our brains out on spending money on sales and marketing. Sometimes that works, sometimes it doesn't. What I know works is getting out there and talking to customers, which we do quite effectively. So we'll continue to spend money doing that for sure. But I'm not going to go and spend many millions of dollars, for example, on a ad campaign or something like that, because I just don't. We tried that a few times and it just doesn't seem to work. So we stay away from that.
The other question here, now I'm not sure if you guys have an NCIB in place, but the question is, given the company is trading at 9x EV to EBITDA, can you talk about how you evaluate share buybacks versus acquiring new companies?
I'm not. We won't be doing any share buybacks because it's not we didn't raise the money based on that. I didn't. I didn't talk to our investors and say, look, I'm going to raise money, then I'm going to go buy it back at a discount. We don't want to do that. I think the market. We've just started. We listed on the OTC a month. About a month ago, we actually got the listing. We don't have our DTC underwriting yet. That's going to be another week. Apparently, it takes a bit of time before we can actually trade on the over-the-counter market. So I believe that once we have a lot of Americans interested in buying the stock, but they just don't want to buy it because it costs more money to buy directly on the TSC without But if on the OTC, then the cost is much better cost base. So we hope that we'll get more action on the stock and see the price, get closer to what I think our peers are. I mean, on an enterprise value, I think we're trading at probably 8 times. And I think we should be closer to maybe 12 or 13. If I look at just conservatively against some of our peers, but if I'm looking against, multiples of revenue, we're way under. So, it's kind of it's just, but, I like to be conservative and say that our if we look at a conservative metrics, and I think we have a nice upside on our stock, and we have an analyst that did a review on the company, and he's much more bullish than me on which is good, I guess, on what he thinks the company will do. But my investors, I think the people who bought in, a lot of the investors that bought in on the listing are in it for a long haul. Nobody's in it to make short-term money. They believe that this is a longer. It is we're here for a while. It's not a flip sort of deal.
Yeah, fair enough. I mean, you're relatively new. You've been around for roughly 6 months or so as a public listing. How are you getting your message out? What are you finding that's working as far as getting your message out about the company?
Well, we're working with what I guess they call them service providers, people that supposedly have a long list of people that are that follow them. So I've been doing interviews, probably 2 or 3 a week, similar to what I'm doing right now, with people. I've video calls. I've done magazine reviews. I've done online magazine reviews. So I'm just basically out there talking as much as I can to as many people as I can to try and get the message out. We also have our, Givex is out in trade shows doing our marketing from our services perspective. But I'm doing as much as I can to talk the talk and get out there and talk to as many people as we can. So we've got 4 service providers, and once we get going in the US, we'll probably get 2 or 3 more that are focused only on the US market. See if that will help. And what I say was working. I don't really know what's working yet, because for me, the stock has kind of stayed where it is, so nothing's working yet as far as I can see. So, the stock is, I think it should be going up. There's not many people buying, but there's nobody selling. So that's kind of a conundrum, right? There's nobody wants to sell it at these prices. Not many. There's but maybe buyers will start buying at a higher price. There'll be more sellers, but that's all right. You guys probably
Gotcha.
know way more about the market than I do. You know, I'm an operator and I'm trying to
Yeah.
learn the market. I
Yeah.
am learning. I'm learning it
Well,
fast.
yeah, we've been at it a long time. We're still having a hard time understanding the market
Yeah.
sometimes. Yeah.
Yeah.
Yeah, maybe just a minute or so on this as we get closer to wrapping up. But the board of directors, we always find it's interesting, especially with smaller companies, the board composition, and where do you see the strengths of the board, and if anything, do you anticipate some holes to fill, or any skill sets that you'd like to see added?
Well, as far as the board's concerned, we've got a good balanced board. We got people that have experience on the board. So we have public company experience. Mike Carrs was an entrepreneur that sold his business to CDW, made a fair bit of money, and then and he now is a CEO of another company. So he's got a lot of experience, a lot of connections for sure. Jim is an experienced CFO, been around for many years, and he did a phenomenal job of getting our. First of all, we had to change over our audit from a smaller auditor to KPMG, and we had to get that all done in a very short period of time. And getting our audit done and completed, KPMG came in and we had 3 weeks to get the whole thing done. And we got the whole thing completed and got it done all with very few issues. And they gave us a huge compliment that, our systems, our process, our procedures, and everything that we have are excellent. Now, Jim is responsible for some, but I'm responsible for a lot of them too, because I put them in place years ago. So, he brings a lot of expertise there. Rob Monroe has been involved in doing these, reverse takeovers. He's done, 12 of them. So he's he's well versed in the market, a lot of contacts and connections in the marketplace. And Miles, who's he's a trust fund guy. He works with a lot of private wealth, a lot of private family wealth. They've got connections in the United States, Europe, Brazil, actually. So he's kind of global. He's got some good global connections. Now, to answer the question, will I bring on more directors? Yes, our intention is to bring on 2 more directors, but I want to get the revenue up further before I'm doing that. The company is, to me, too small to justify more than a 5-person board. So we will get it up to, I want to get it up to between 70 and 100 million. And then we're going to start thinking about adding 2 more directors. Definitely a woman, and definitely for sure we'll add at least 1 female director. And try and get some. That'll be definitely part of my objectives.
Gotcha. From an investor standpoint, so us sort of sitting on the side of the fence, what sort of catalysts or metrics do you think makes the most, is the most important for us to watch to determine how you're performing?
Well, actually, I guess there's 2, which would be kind of revenue per customer, because or per location, because that's how we really measure how we're doing. How many locations we've got and what are we generating in revenue. That's a pretty easy metric, because you can divide the revenue by the number of locations we've got, and just to see if it's going up or down or staying the same or what's happening to it. It'll stay pretty stable if the majority of our business is kind of gift cards, which it is today. It's not going to change a lot, because we've kind of built it into that we know what it should be, and it is that. But as we start getting more and more of our business we start adding more clients that are using a platform, that number should start to grow, and we expect it to grow. The other metric, which we cannot measure yet, which we're going to start measuring, we're putting systems in place to start measuring, is how many clients have we moved from one thing to another. In other words, how fast are we moving customers from from the first item that we sold them to the second item they sold them? How fast are we moving them from a $50 client up? And how many are we doing that? Are we getting per month that we're adding to that metric? Those are important kind of, for me, growth metrics, because it tells us that our model's working. The other one for me that's important is my payroll as a percentage of gross profit, because to me, we have to be careful that we're keeping our payroll in line with our gross profit, so that we're always going to be able to make our EBITDA. If I let that get out of control, then we can find ourselves in, all of a sudden, before you know it, it's just can eat up our profit pretty quickly if we let the payroll get out of control. Payroll is by far our biggest expense, no question about it. So we want to be able to keep that. Everything else is pretty well fixed. payroll, it can go up and down. It can vary widely. You know, we want to hire people to build bench strength before we do acquisitions. The acquisitions may take a little longer than we expect, or we're hiring more bench strength in order to prepare for opening another territory or adding launching a new product, and it takes a little longer. You know, you just can't fire the people and hire them later. But you build it up. You got to build the expertise. So, you know, as you asked me earlier, what's our biggest concern? My biggest concern are people, and it all ties back to how many people do we need in order to be able to drive the business profitably, and and do it in such a way that we don't get overcommitted there, and it hurts our profitability.
Gotcha. Don, I'm going to give you an opportunity to sort of give a parting message or key takeaway. If there's one key thing you want everybody to walk away with today as far as a message, what would that be?
Well, GIVX to me is I guess you would call it a de-risked investment. It's a sort of investment that if people are going to invest in a company where they feel that they can put some money there and sit on it for a while and see it grow over time, I think GIVX is the company to do that with. We aren't doing it now, and we probably won't do it for a while, but I paid dividends in GIVX for 10 years straight. So I got to the point where I wanted to, we were making good enough money that we started paying dividends to our shareholders. So, I'm not saying that GIVX is in a position to do that today, but it's certainly something that I would be interested in doing once we get, we got to get to a certain size. We have to be comfortable with our with our base of revenue and the cash flow that's being there, and then we'll probably look at doing that. So it becomes an investment that's kind of growing, and at the same time could be a dividend company. So it's that. I mean, that's very much speculative, but if I'm trying to give a message, it's that we're a company that pays attention to our bottom line, pays attention to our investors. We're trying as hard as we can not to pay attention to what's going on in the market, but we really don't have much control over what's going on there. I have control over those other two things, but I don't have a lot of control over what's going on in the market.
That's absolutely true. Listen, if investors wanted to know more about the business, what's the best way to get more information? A website or contact?
We have a whole investor relations section on our website that's got as I do interviews and do videos, they're all there. I think that the analysts, not the report's not there, but who the analyst is, if you want to go follow what the analyst has to say, you can find him there. All of our current financial information is there. So that's probably the best place to go. Plus the website, it's pretty good. We're redoing our website overall to try and be more, it needs a refresh. So, but the website and the investor relations section on the website is good. And of course, if you feel that your followers are interested in having a follow-up meeting, I'm more than happy to do that anytime you feel that would be warranted.
Fantastic. No, fantastic. No, we certainly look forward to an update in the future. So today we've been speaking with CEO Don Gray of GIVX Information Technology Group, GIVX on the TSC, or TS, it is the TSX. TSX. I keep referring to the old TSC. So GIVX on the TSC. Don, I want to thank you one more time for joining us today, and it'd be a pleasure to catch up with you in the future.
Great. Thank you, Paul. Appreciate your time.
You got it. Appreciate it.